Welcome to This Explainer. Today we're skipping the fluff and diving straight into a massive policy shift in China's Greater Bay Area. It's a move that, quite frankly, fundamentally rewrites the financial math for foreign businesses operating there. If you're currently evaluating where to set up or expand in the region, this intelligence is absolutely essential to your strategy. Okay, let's dive into this, and let's start with the most critical number, 10%. That is the massive 10 percentage point gap between China's standard corporate income tax rate and the newly expanded preferential rate in the Shanghai zone. When you're talking corporate site selection, a 10% tax differential isn't just some rounding error, right? It's a major structural advantage. Today, we're going to look at exactly how you can leverage that gap. To get there, here's our roadmap. We'll kick things off with Section 1, the Qianhai Advantage. Then, Section 2 covers individual tax exemptions, followed by Section 3, corporate tax reductions. After that, we'll outline compliance in Section 4, how to qualify, and we'll wrap it all up with Section 5, actionable business steps. Let's jump right into Section 1, the Qianhai Advantage. So, Shanghai isn't just another run-of-the-mill business park. It strategically sits right at the geographic center of the Greater Bay Area. We're looking at a 120.56 square kilometer zone that offers something genuinely rare. It merges the legal and financial proximity of Hong Kong with direct, unfiltered access to mainland China's market. Now, historically, stationing your senior talent on the mainland has been prohibitively expensive. Shanghai actually solves that problem, making it incredibly competitive with traditional hubs like Singapore or Hong Kong.
That brings us perfectly to Section 2, individual tax exemptions.
And this brilliantly illustrates the exact problem with cross-border talent flow. This new policy targets Hong Kong residents working in Qianhai, and get this, it's effective retroactively from January 1st, 2023 through the end of 2027. Look at the stark contrast. Mainland China's standard individual income tax is progressive. It scales all the way up to 45%. Meanwhile, Hong Kong's salary tax tops out at just 17%. That huge gap used to kill executive mobility dead in its tracks. But under this new policy, eligible Hong Kong residents are completely exempt from paying the mainland tax portion that exceeds their normal Hong Kong burden. The gap is literally eliminated. Let's put that into perspective with some real math. Take a Hong Kong executive earning, say, 2 million RMB a year. By working in Qianhai under this exemption instead of some non-preferential mainland location, they'd save roughly 250,000 to 400,000 RMB every single year. That is a game-changing amount of personal savings. For you as an employer, it means you can offer highly competitive net pay without artificially inflating your gross salary costs. Now, let's flip over to the corporate side of the ledger in Section 3, corporate tax reductions. While individual breaks are amazing for retaining top talent, the corporate income tax, or CIT, reductions fundamentally alter your P&L. This 15% Shanghai rate was initially introduced back in 2021, but it's now seen a massive territorial expansion. The contrast here is undeniable. The standard China corporate income tax sits at 25%, but the Shanghai rate is just 15%. And this reduced rate is locked in through December 31st, 2025, which creates a huge, immediate strategic window for optimizing your tax burden. And the actual footprint for this rate has grown exponentially to cover that entire 120.56 square kilometer zone we talked about earlier. This now includes major commercial powerhouses like Shinku, Shenzhen, the Convention and Exhibition City, Ocean New City, and the Bao'an Central Area. Now, here is an absolutely crucial organizational detail to remember. If you establish your headquarters in Shanghai, that 15% rate applies to eligible income from both the head office and any branches located inside the zone. If you have branches outside the zone, the reduced rate only applies to the qualifying ones inside Shanghai. So the crucial point is what this means in hard currency. That 10 percentage point reduction translates to a cool $100,000 saved for every $1 million in taxable profit. Think about that compounding over a standard 5-year investment horizon. You're looking at $500,000 in freed up capital. Capital that can be injected straight into your top-line growth. You could find a new senior executive hire, roll out a major technology upgrade, or run a new market entry pilot, all without touching your existing growth assumptions. It's just pure optimized capital. Moving right along to Section 4, how to qualify. So capturing these savings means passing some pretty strict qualification hurdles. First, your company has to operate in an encouraged industry from the 2021 Qianhai catalog. The heavy hitters here are modern logistics, information services, technology services, cultural and creative, and professional services. But here is the critical caveat you cannot ignore. Just being in the industry isn't enough. Over 60% of your company's total income generated in Qianhai must specifically come from those encouraged activities.
Now, what's really interesting here is the strict compliance test for substantial operations. The authorities want actual, tangible economic growth. So you cannot just rent a desk, slap a brass plaque on the door, and call it a day. Brass plate or shell companies absolutely do not qualify. To get this tax break, you must have real staff, real day-to-day business activities, and actual management decision-making physically located right there within the Qianhai zone.
Let's bring it all home with Section 5, Actionable Business Steps.
Let's walk through this action plan briskly. Step 1, run a tax comparison. You need to model your effective tax rate across Hong Kong, Shanghai, and a standard mainland location to see that 10 to 15-point difference for yourself. Step 2, audit your activities against that encouraged catalog. Actually, a quick pro tip. Even if you're a manufacturing firm that wouldn't normally qualify, you might want to consider setting up a Shanghai-based services subsidiary, like an R&D or procurement arm, just to capture this rate. Step 3, review your Hong Kong talent pipeline. Adjust your compensation models to bake in that individual income tax exemption. And Step 4, watch the CIT renewal timeline closely.
Speaking of timelines, you've got to factor these exact expirations into your investment horizons. The policies retroactively kicked in back in January 2023, but, write this down, the current 15% corporate income tax rate expires in December 2025. Now, while most analysts suggest renewal is highly likely based on past precedent, it's not legally guaranteed. The individual income tax exemption gives you a little more breathing room, expiring in December 2027. So make sure you're building these dates into your financial modeling.
Which brings us to the ultimate question for you to answer today. Is your Greater Bay Area strategy leaving tax savings on the table? Relying on old operating assumptions could quite literally mean missing out on millions in capital over the next few years. Thank you so much for joining me for this explainer. Get together with your finance teams, run the numbers, and see how your operational math stacks up against what Qianhai is offering today.